Welcome to Thoughts on the Market. I'm Michael Zezas, head of Global Thematic and Public Policy Research for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between public policy and financial markets. It's Wednesday, November 30th at 11 a.m. in New York. Investors remain intently focused on China's COVID policies, as the tightening and loosening of travel and quarantine policies has implications for key drivers of markets, namely the outlook for global inflation, monetary policy, and global growth. We're paying close attention, and here's what we think you need to know. Importantly, our China economics team thinks that China's restrictive COVID-0 policy will be a thing of the past come spring of 2023, but there will be many fits and starts along the way. Increased vaccination, availability of medical treatment, and public messaging about the lessening of COVID dangers will be signposts for a full reopening of China, but we should expect episodic returns to restrictions in the meantime as China tries to smooth out its COVID caseload. This dynamic is important to understand for its implications to the outlook for the global economy and key markets. For example, the economic growth story for Asia should be weak in the near term, but begin to improve and outperform the rest of the world from the second quarter of 2023 through the balance of the year. In the U.S., the reopening of the China economy should help ease inflation, as the supply of core goods picks up with supply chains running more smoothly. This in turn supports the notion that the Fed will be able to slow and eventually pause its rate hikes in 2023, even if headline inflation sees a rebound via higher gas prices from higher China demand for oil. And where might this overall economic dynamic be most visible to investors? Look to the foreign exchange markets. China's currency should relatively benefit, particularly if reopening leads investors back to its equity markets. The US dollar, however, should peak as the Fed approaches pausing its interest rate hikes and, accordingly, ceasing the increase in the interest rate advantage for holding US dollar assets versus the rest of the world. Of course, the evolution of the COVID pandemic has been anything but straightforward, so we'll keep monitoring the situation with China and adjust our market views as needed. Thanks for listening. If you enjoy the show, please share thoughts on the market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.